Good morning, everyone. My name is Agyei Opoku-Agyemang. I work with Blackstar Brokerage. I welcome you to day 2 of the BSB Investor webinar series. Yesterday was the first day, and it was for the investment management fraternity, where we had good discussions into our industry, and it had a lot of representation from fund managers, trustees, and it was graced by representatives from the Ministry of Finance, the MD of the Ghana Stock Exchange, amongst other dignitaries. Today is the session that we are holding for a very important sector of our financial sector, the sector that is very much responsible for financial inclusion and building our economy. I'm talking about savings and loans, microfinance, and rural and community banks. So just as we did for yesterday, today we will have strong representation from the Bank of Ghana, led by Mr. Steve Opata. He is the director in charge of financial markets. We also have Mr. Mustafa Sabin, who is also from the BOG, and Dr. Claudia Kuma. Then we also have representation from ARB Apex Bank that will be led by the acting MD, Mr. Alex Awuah. Then finally, we will also have another presentation by Mr. Eric Appiah, who is the managing partner for Blackstar Advisors. Without much ado, I would like to draw your attention to some housekeeping matters. Whilst the presenters are making their presentation, if you have any comments, feel free to type it in the Q&A section, or you can write it down. The presenters will have 10 minutes to make their presentation. Right after, we will do some 5-minute engagement. Then we'll move on to the next presenter. Then another 5 minutes for comments, inputs, and questions. Then when we are done with all the presentation, we'll do the general Q&A. So either way, you can put through your comments, questions, and inputs. When we are done too, and you would like to speak directly, we will give you the option. You just follow the protocol of clicking the hand button on your Zoom app, then we will let you in. So I welcome you once again, and just stay back for a very insightful day on the work we do. And let me just remind you that the main theme for this webinar is reliability in times of uncertainty, making resilient investment decisions whilst transitioning from a pandemic and financial sector reforms. We are all aware of these challenges and the impact it's had on our businesses and the economy by extension. That notwithstanding, we need to move on. We need to review what we do so that we grow, such that perish the thought in future, if should there be anything higher than a pandemic or anything, our businesses will be able to flow as they do. So ladies and gentlemen, I introduce you to my colleague, Mr. Emmanuel Kujo, who is head of our securities trading, to take over for the moderation of the event. Thank you.
Thank you very much, Nana. And as he already said, we have good representation from Bank of Ghana, who is a mother institution when it comes to deposit taking institutions in the country. So the first presentation, I'll just head straight to it, will come from Mr. Steve Opata. And in line with the theme for the webinar, he's going to speak on decision-making in terms of transition from the pandemic and the financial sector, and the role and expectation of the central bank. So Mr. Stephen Opata, if you can hear me, good morning, sir.
Good morning, and hello to everyone. First, I want to thank all of you want to thank all of you for, and especially Star Brokerage for inviting me to this program. Really, what I want to do here is to make some few remarks in terms of what we have seen in the first two quarters and present an outlook to set the context for the discussions here. So in terms of what I would like you to take away from this session, first is that what we see, and most of the remarks I will make here are based upon, we just finished our MPC meetings, and so that gave us a very recent outlook to what's happening globally and domestically. So most of my comments really will come from the latest analysis and data we have of global economic conditions. So the first thing I want to say is that from where we sit, we see risk to inflation and growth at this point to be broadly balanced. So, we don't see major risk to inflation, at least in the very short term. And inflation within the economy is likely to sit within the policy band. We are also seeing growth re-emerging, growth picking up from the shocks we saw in the system on the onset of COVID. Now, in terms of the key takeaway, we are seeing global growth recovery especially in advanced economies, and that's also trickling to emerging market economies. But at the same time, we're also seeing some tightening of global financing conditions. And we've also observed rising global inflation trends. So if you put all of this together, the fact that economies are beginning to grow, but we see some tightening because of resurging global inflation. If you put all this together, then it's likely there could be some spillover effects of that on the Ghanaian economy. So for you as an industry that helps in the financial intermediation, I think it's important to have that context in mind. The economies are beginning to regrow. So we expect the Ghanaian economy also to pick up steam. But at the same time, we're seeing some re-emergence of inflation, even though in the short term, that may not impact on Ghana. It's something to keep in mind in terms of how you price your transactions and how you discover pricing when you give out loans and so forth. To get into a little bit more details, what we've observed, and this is according to recent surveys, that growth momentum has picked up following the COVID-19 shock. This is mainly due to continued policy support, both on the macroeconomic level and on the fiscal level, and also mass vaccinations that we've seen, especially in advanced economies. We've also observed removal of restrictions of movements across several advanced countries. However, despite this progress at reviving these economies, we've also seen some risks still emerging from the rapid spread of the COVID-19 variants, especially the Delta variants. And there's reports of some vaccine hesitancy, even among some advanced economies, and lack of vaccine availability across emerging and developing economies. So these events have heightened uncertainties, and this may derail the growth momentum that I've just talked about. On global financing conditions, they remain favorable that could support the growth recovery process. But hence, financing conditions are a little bit tighter because of the growth momentum we are seeing and high inflation, especially in advanced economies. If you look at US inflation right now, it's over 5%. This is the highest it's been over a decade. So you can see that inflation is re-emerging, but according to the analysis, this inflation actually is temporary. We are encouraged by the fact that advanced economies and quite a number of economies are still pursuing accommodative monetary policy, which will moderate the spread, sovereign and corporate spreads. And if this continues, if this accommodative monetary policy continues, then we could see less strain in terms of capital flow reversals. And this is supportive of rebound in equity markets. And I think we're seeing some of that already in our markets, where the Ghana Stock Exchange seems to be seeing some rebound this year. We've also seen relatively higher portfolio flows, especially in the first quarter for Ghana. And this is not just for Ghana, but in quite a number of emerging market economies, we've seen portfolio flows beginning to come back, even though there are differences in country-specific considerations. In terms of inflation, since the beginning of the year, headline inflation in several advanced and emerging market economies have picked up sharply above targets, mainly driven by energy price pressures and supply constraints amidst increased consumer demand as economies have reopened. However, the expectation is that in the medium term, inflation will return to target in most of these economies, moderated by the still sizable spare capacity and the slack in labor market conditions and restrained wage growth. In emerging and frontier economies such as ourselves, the pace of price movements will be largely dictated by currency movements, that's the exchange rate movements that we see, and also COVID-related supply side constraints. So essentially what we're saying here is that inflation that has picked up in advanced economies may pause after a while, the advanced economies, but for emerging economies such as ours, a lot will actually depend in terms of price movements. A lot will depend on how currency movements play out, and also the supply chain considerations regarding COVID, imports, how imports flow and exports are flowing, and so forth. So in our domestic economy, according to the Ghana Statistical Service, the latest read on GDP, we saw a 3.1% growth in the first quarter of 2019, which is, even though this is lower than the 7% we saw the same period last year, is quite assuring that growth is beginning to pick up. And we expect this momentum to continue, barring any shocks, such as the severity of the COVID Delta spread that seem to be emerging even in our country. So headline inflation has also eased sharply and has reverted into medium-term target band of 8 plus or minus 2%. And this is really driven mainly by the tight monetary policy stance of the central bank and some base drift effects. If you compare to what happened last year, then there's some base drift effects happening there. So our forecast, that's the Bank of Ghana forecast, is that inflation will still remain broadly unchanged within the band, at least for the rest of this year and the forecast horizon, barring any upside raise from fiscal pressures. Now, this momentum in the build-up of growth is also supported by high-frequency economic data indicators that we've seen in the second quarter. If you take the Bank of Ghana's Composite Index for Economic Activity, it recorded a strong annual growth of 33.1% in May, relative to a contraction we saw in 10.2% the same period in 2020. So the story here is that growth is rebounding. If you look at high frequency indicators and you see what Ghana Statistical Service reported for Q1 of 2021. Now, when it comes to the sector that we are talking about today, that's the specialized deposit taking institutions subsector. We have seen that we've seen gains from this sector after the pre-pandemic cleanup efforts by the central bank. If you take data that we have up to May of 2021, that's you take the financial soundness indicators data, we see that strong profit performance and strong balance sheet growth is happening. The total deposits of the savings and loans companies and finance houses, rural and community banks and microfinance companies has grown, for example, by 30% year on year. So that is very strong. And total advances have also increased by 16% compared to same time last period. So if you look at all these dynamics for your sector, then you see that profit is growing and advances are also growing. And that's something we want to see, because if you look at the analysis, you see that real private sector credit has been somewhat sluggish. And that is why this presentation here today is very significant, because essentially we see opportunities here for you to pick up more credit, especially to some of the sectors where we think that we will need some push for growth to continue. You know, the pandemic affected quite a number of sectors, but some sectors were hit even more harder. So there's opportunity here to deliver credit to this sector, and I think that's something that the group that we are talking to today can take a cue from. There are some concerns though, and it's mainly in the sluggishness in new lending, which could undermine the growth momentum. We are concerned a little bit that private sector credit it's sluggish, and you see a lot of the credit delivery happening on the government of Ghana's side. And we think that the opportunities for credit to be delivered to the private sector, if you can screen or do proper assessment of credit and price recovery. And I think that's something that the sector has to consider. Overall, I want to end my remarks by saying that we think that the risk to inflation is broadly balanced, and inflation should stay within the target for at least the medium-term outlook, and there's opportunity for the economy to grow more. And this is where we think that the non-bank financial institutions like yourself can take opportunities, given the many initiatives that the central banks has taken in the past 2 years to reform the sector. We think that the balance sheet of the sector that we are looking here is stable now, and there's opportunity to deliver credit to your customers. I think I'll pause at this point. I think I've done close to 10 minutes. I'll pause here and then hand over to the moderator.
Yeah, thank you very much, Mr. Opata. And as you say, you've done justice to the topic, and we are all excited about the fact that the deficit's growth rate of 30% has been recorded so far already, which is an exciting thing. And maybe taking a cue from your last few sentences on the fact that we should all work towards making sure credit gets to the private sector. I think we have a lot of audience here who are listening, and I believe they will also work towards that. We would note the questions and move on to the next speaker. So when the speakers are done, we'll direct the questions to the speakers, and which would set the tone for the discussion to continue right after the presentation from the speakers. So without not taking my time again, I'll move on to Mr. Sabin to give his presentation, which would look at the governing principle of the SDIs in making investment decisions. So Mr. Sabin, good morning, can you hear me?
Good morning.
Good morning. Yeah. So I'll hand over to you then.
Okay. Thank you very much. And good morning to Mr. Opata as well, who is our director. I'm representing my head of department, Mr. Afedzie, in this presentation. Just as you alluded to the topic, we are to look at the governing principles of the SDI in relation to the topic as the reliability in times of uncertainty in making investment decisions while transitioning from a pandemic and financial sector reforms. Basically, we want to look at the situation, the reforms that the Bank of Ghana put in place prior to the emergence of the pandemic, and what measures the Bank of Ghana put in place during the pandemic to assuage the hardships that the financial sector players observed. We also want to look at what are some of the, notwithstanding all these issues, both the reforms and then the pandemic, what are some of the guiding principles that an investor will take when he wants to invest in the SDI sector? if you look at the reforms that were put in place by the Bank of Ghana to clean up the financial sector, we noticed that a lot of SDIs licenses were revoked to the extent that over 23 SDIs, that's savings and loans and finance houses licenses were revoked. And the revocation was occasioned by these institutions not putting adequate capital. They did not observe the requisite practices that a financial institution is supposed to observe. We observe in those situations that corporate governance practices were not followed, and the institutions actually, some of them channeled deposits into financing personal projects. We also noticed that some took excessive risk, which without commensurate risk management practices. So all these occasioned the revocation of the licenses of some of the SDIs and microfinance institutions. So the Bank of Ghana, having cleared the sector and was poised for a takeoff, unfortunately, the pandemic also happened. Notwithstanding that, the Bank of Ghana took measures to ensure that the banking sector was sound by releasing liquidity into the system. Banks that had cash reserve requirement of 10% was reduced to 8%, so that they could have more liquidity into the sector. Capital conservation buffers that was about 3% was reduced to 1.5%. These were measures that Bank of Ghana put in place to ensure that the banks and SDI sector had enough liquidity to support sectors that were badly hit by the pandemic. So fortunately for us, these measures have been able to stabilize the banking sector. And without this, the cleanup exercise and the measures that were taken by the Bank of Ghana within the pandemic, the banking sector would have been adversely hit. Now, if you are an investor and you want to invest into this SDI sector, microfinance and rural and community banks, what are some of the guiding principles that you have to adopt? Basically, the Bank of Ghana Act 612 gives the Bank of Ghana the mandate to ensure that the sector is supervised well, so to be sound. Likewise, to the banks and SDI Acts also gives the Bank of Ghana the mandate to ensure that we have a sound banking sector. So based on this, the Bank of Ghana came out with corporate governance directives to guide both banks and SDIs, as well as the rural and community banks. And also, the Bank of Ghana published a business rules and sanctions for microfinance institutions. That was in September 2017. So all these principles or laws are guidelines that are supposed to ensure that the SDI sector and microfinance and rural bank sector operate in a sound and safe manner. In that state, if you are an SDI, we expect that you have to maintain sound corporate governance principles. In other words, when it comes to the board and senior management with respect to appointment, you must ensure that you have people who are fit and proper to undertake your businesses. You must employ or engage people with competent experience and qualification to do your business. The corporate governance directive has a lot of sections that deals with sound practices, which have been a replica of what is in the Banks and SDIs Act as Act 19. Now, coming specifically to the issue under consideration, if you're an investor, notwithstanding what has happened in the financial sector reforms and the pandemic, and you want to invest in the SDI sector, what do you have to do? It is our view that at the stage of incorporation, if you are coming in as a new investor, you want to set up a bank, an SDI or a microfinance that will take deposits. You have to ensure that you comply strictly with provisions of Act 992, that's the Companies Act, with regards to how to incorporate your institutions. The Bank of Ghana Act has relevant provisions dealing with how you should apply for a banking license. You must comply with all these requirements. You must also be conversant with the relevant laws, as I've indicated earlier, which pertains to the SDI sector. And luckily, the SDI and banks have the same Act 930 that regulate their activities. And we also have the corporate governance directives, which was fashioned out for banks, SDIs, and financial holding companies. So you should be conversant with all these relevant provisions in the Act, as well as the corporate governance directives. If you are also investing, not necessarily incorporating a new company, but you want to acquire the shares of an existing SDI, then the Act 930 gives directions as to what to do. You cannot obtain more than 5%. If you want to obtain 5% and beyond of the shares of an institution, of an existing SDI, that means that institution has to obtain the prior written approval of the Bank of Ghana before you be engaged in discussions, as is required in the Act, Section 49 of the Act. Assuming you want to invest in the rural and community bank sector, then the requirements are that if you are a natural person, you cannot invest more than 30% of the shares in the rural and community bank. Also, if you are a family or related persons and you want to invest in the shares of the SDI, your investment should not exceed 40% of the equity of the rural and community bank. And if you are a corporate body, it should not exceed 50%. As a matter of fact, without the intervention of Bank of Ghana in the financial sector in the form of cleaning the system and also putting in measures to support banks that were hit by the pandemic, the banking sector would have been a situation that the effects would have been unimaginable. You may agree with me that these measures have gone away to stabilize the banking sector, notwithstanding the ravages of the pandemic. In the midst of all this, our advice to the investor is that any potential investor into the SDI or microfinance or rural and community bank must ensure that the relevant provisions of the laws that I have alluded to earlier on are read thoroughly. You must also do your proper due diligence before you engage in investment. I'm done, Mr. Chairman.
Thank you very much, Mr. Opata. And that was a good presentation on where we are in terms of corporate governance for SDIs moving forward. I have a quick question for you, and I think I had, for listening to your presentation, I had a lot more encouragement. I saw that you seek to encourage investors to do more investment with SDIs. One thing that was very clear when the financial sector cleanup at the SDIs parts happened was the fact that some of the SDIs had their investments, I should say, at wrong places, which ended up having deposits being locked up. So my question to you is there moving forward, and as we transition from that, is there a new policy guideline that seek to make sure SDIs do not put investments in non-permissible assets to avoid a situation of having funds or deposits being locked up?
The SDIs, if you look at Section 18 of the Act 930, we have permissible activities that a licensed institution is supposed to engage in. And normally, these SDIs are supposed to keep primary reserves and secondary reserves, but primary reserves are mandatory. So some of them ended up inputting their monies in institutions that were not liquid in a way, which end up being insolvent. So the rules are there. There is no, they breach those rules. So in my view, it is just an enforcement of the rule. That should be a way out. So if you're an SDI, let's say in the context in which we are discussing, if you're an investor who has set up an SDI or microfinance institution, you have to ensure that before you invest, you put your excess liquidity in the form of investment to an entity. You must ensure that particular entity is solvent. Has that institution been publishing its financial statement over the past 3 years or more? You need to do proper due diligence before you just invest your money into. You are taking deposit funds. So if you want to invest into another entity, you must be satisfied beyond reasonable doubt that that institution is solvent and liquid. You don't be assuaged or attracted by the interest they are paying you. And some of them, this is what landed them into serious financial difficulties. Thank you. Oh, sorry. I think I had muted. I had not muted myself. Hello. Hello. Hello.
Yeah, hello, Mr. Opata, can you hear me?
Hello.
Stopping.
Hello.
Yeah, hello.
Hello, I can hear you. Hello. Yes.
Yeah,
I can hear.
It appears you didn't hear me.
Yes, please go ahead. Go ahead. Repeat
Hello. I mean, did you hear my submission?
Yes,
your
In relation to
submission.
the question you asked.
Yes.
All right,
yes,
thank you. I thought I'd admitted.
Yeah, we heard everything, and I just wanted to add that we at Blackstar have engaged a number of SDIs, and it was very clear from our engagement with them that they are very cautious on where they move their money is moving on, and I think a lot of them have, learned their lessons from what happened prior to the financial sector cleanup. And again, I'm sure they were very excited when you encourage that. Deposit invest in SDI, because when we engage them, they also stress on that point. So thank you very much for your answer to that. And actually, just to the audience, you can keep dropping your questions on the Q&A section of part of the Zoom app, and we'll get back to the speakers with the questions as soon as you send them in. Now we'll move on to another important institutions in our financial sector space, which is ARBFS Bank, and we would have Mr. Alex Awuah do a presentation, which he's going to look at the need for strategic investment decision that will suit the need of firms and withstand the test of time. So, Mr. Awuah, can you hear me?
Yes, please, I can hear you.
Great. So you take over from me again. Thank you.
All right. Thank you very much. And I give thanks to the Blackstar Brokerage for organizing this webinar. And post-pandemic, post-financial sector reforms, it is something which is so important that our industry should get this exposition. Now, the topic that has been given to me, the need for strategic investment decisions that will suit the needs of firms and withstand the test of time. So important at this time because actually, when you look at the balance sheets of our institutions, rural and community banks, now total assets portfolio of about 6.4 billion. Investment constitutes about 3 billion, which is almost 50%. And also, when even you compare it to the loan portfolio is about 2 billion. That is statistics as at end of March. So you can see the importance of investment. And also, the financial sector cleanup that came. We also saw that many of our banks had investments in many institutions. And at the end of the day, most of these investments had to be impaired, and it was quite significant. And the impact on the capital adequacy solvency position until today, we see the effects. Now, taking investment decisions, we have to go through some strategic framework for the considerations, of which the pandemic is quite significant. Now, when you look at the strategic framework within which we take decisions, we have the political environment. It goes with a whole lot of uncertainties which our institutions do not have control. The first is the political environment, the economic environment, and I think Mr. Opata highlighted significantly on the economic environment. Now, the sociocultural side, where we have the health problems, especially the one we are witnessing, legal regulatory. Now, in the specific context of our discussion today, we narrow it down to the pandemics, which is part of the social issues that we deal with, and also the legal, in the sense that the legal regulatory context, the financial sector reforms, these was spearheaded by the Bank of Ghana and the government of Ghana. Regulation, legal issues are key when we're taking decisions. Now, the impact of the financial sector reforms and the pandemic on the SDIs. We can see that the after effects of the financial sector reforms, especially, was the investments that got locked up. Thanks be to God, institutions that were under, Bank of Ghana, regulatory system, we've gotten the monies paid back. But then, as we speak today, we have many of our institutions which funds have still not been paid, especially institutions that were under the Securities and Exchange Commission regulation. So this still constitutes a problem that we're dealing with. Also, liquidity issues. You see, when you have significant funds locked up and you're not getting it, your customers also need their money. And that is where the liquidity issue comes in. And we see that the after effect was quite significant. In fact, for the RCB sector in particular, because Apex Bank was there to provide some assistance in terms of liquidity, we did not see the impact as expected. Deterioration in asset, and as we all know, we make provisions in the same way to cover these investments that have been that have deteriorated. In the same way, we make provisions when we give our loans. Capital erosion, and when we make these provisions, certainly it will affect our bottom line, and our income surplus is also affected. And this has a significant effect on our solvency position. So, and we also saw that the pandemic came at a time when many of our institutions, especially in the SDI sector, had not been prepared. The digital platforms that that should have been available for us to, deploy our operations were not in place, and many of us had challenges. Now, why do we need to invest as SDIs? And I think we are all very much aware that we collect deposits, and for that matter, we need to deploy the funds to earn some income so that we make some returns. And at the end of the day, we grow our institutions. Liquidity is so key because you are collecting monies from people. And for that matter, if you invest, you have to get it at the back of your mind that that investment will be available when your depositors or your customers call on you for their monies. Diversification and growth of assets, we need to diversify. Essentially, we cannot use all our resources in terms of the deposits we're mobilizing to invest in loans. And we need to ensure that there is a balance on a balance sheet so that our returns can be secure. And importantly, depositors' funds, we always have to ensure that the depositors' funds are safe. And for that matter, when we're investing, we put it in assets that we can, correctly judge that at the time that we need the monies, we can get it back for our depositors. Now, what investment strategy do we have to, recommend to our banks, our institutions, especially the SDI sector? This investment strategy should be informed by the desire, the appetite for more income. You see, you may have the appetite for more income, potential to earn more return, but then we should also have it at the back of our mind that the risk and return trade-off is quite important when we are taking side. In the past, before the financial sector reforms, we saw that many of our institutions were investing in some institutions which promise very attractive rates. But then at the end of the day, we came to realize that some of these institutions were in fact not strong as expected in terms of governance, and their collapse led to many issues. So when we are investing, the investment strategy, as much as we consider we have the appetite to earn more income, we should also be cautious that the risk return trade-off, when the interest rate that is promised you is so high, you should also know that it goes with a lot of risk. And for that matter, it may come that sometime when you invest, you may not get your money back. Now, the regulatory, liquidity reserve requirements, these are minimum thresholds, and we have to take it at the back of our minds. In fact, as we speak, we know that the primary reserve has been reduced to 6%, and we should ensure that in our investment, the primary reserve margin, we always maintain it. And then the asset liability mismatches. Certainly, if you don't match your assets and your liabilities, your people will come calling on you for their monies, and you may not have it. So you need to ensure that in terms of tenor, in terms of interest rate, there is some kind of balance so that at the time that you need your money, you cannot experience liquidity issues. Now, solvency should be at the back of our minds. And actually, the Banks and Special Deposits Institutions Act, the Act 930, has provisions. And under Section 29, the minimum capital adequacy ratio, we have to ensure that we always work within, because without that, there are rules which can bar us from, do 1 and 2. Banks and SDIs with capital adequacy ratio less than prescribed ratio shall not take an institutional placement or receive a deposits with a rating approval from Bank of Ghana. So when we're investing, what is our solvency position? And if we don't comply, then we don't have the capability in terms of the regulatory setting to do that. The types of investments. What are the types of investment that SDIs we should be considering? Now, when Mr. Mustafa Sabin was delivering, I think he made mention of the requirements which used to be in place, the primary reserve requirement, the secondary reserve requirement, which was abolished some years back. But then, the regulations are there to ensure that we work within it and ensure that whatever investments that we do, at the end of the day, depositors' funds are preserved. So, as of now, government treasury bills, notes, and bonds should be under consideration. Bank of Ghana bills, commodity bills, corporate bills that are traded. They may be good, but they are very risky. And for that matter, as a bank, sometimes you need to be a bit conservative. And we strongly recommended that looking at what's happened, the after effects of the financial sector reforms, we should consider government treasury bills, notes and bonds, Bank of Ghana bills, and these commodity bills, essentially the bills that are issued by the Ghana Cocoa Board. These are quite good investment assets that we should be considering. Now, how do we build resilience into our investment strategy? We have to do scenario thinking in the sense that from the introduction to this presentation, we saw that the environment, the political environment, the legal regulatory environment, the social environment, they have impact on the decisions that we take. And for that matter, uncertainties are there. They are increasingly complex and volatile, and we should always do some scenario thinking. What will be the impact if there are certain changes in the environment so that we can have alternatives? Now, we should also get it at the back of our mind that there is risk of default. And if there is default, of course, asset quality will be impaired, and also prudence. Prudence in the sense that we are working within certain standards. And
yeah, hello, Mr. Awuah.
Standards which come from Bank of Ghana, financial, things that you need to work with. And when you
remind him that we lost him.
So yes, so hello.
Yeah, hello.
Hello.
Hello, Mr. Awuah. Can you hear me?
Yes.
Hello, Mr. Awuah, can you hear me?
Okay.
Okay, so we lost you for about 3 seconds. So I don't know if you can go back a little bit, then I think your line is clearer now. So.
Okay. I hope you can hear me now.
Yeah, I can hear you loud and clear.
Okay, so I was talking about building resilience into our investment strategy. How do we ensure that our investment strategy or investment decisions are sustainable? Now, the key thing is that, as in the opening remarks that I made, we work within a certain environment, and we should ensure that we do some scenario thinking. The uncertainties that we're exposed with, the complexities, the volatilities that we're exposed to, we should, scan the environment, understand these things so that we think aloud. You see, we do scenario thinking, and then we bring all these factors at play when we are taking investment decisions. And also, we should also get it at the back of our mind that there is risk of default. If things go bad, investment can be impaired. If there is default, your investment can be impaired. Your asset quality, your assets will deteriorate. And the fact is that we are working within certain standards that are emanating from Bank of Ghana, and you have to also work within the international financial reporting standards. And these standards compel you to downgrade assets. So when investments are bad, certainly Once you're working within this standard, you have to make impairments. And these impairments, at the end of the day, will affect your solvency position. So when we're investing, we have to take these matters into consideration. And also the quality of advice, investment advice that you receive. And now at the rural banks side, the rural and community bank side, actually the ARBA First Bank regulations, we have regulation 13C, which mandates RCBs to seek approval from the ARBA First Bank before they do deposit placement. So you should choose your investment firms carefully. And that one, we can also always give the RCBs the assurance that the ARBA First Bank is ever ready to assist them to do investments that are of quality. And also, we need to get it at the back of our minds whether the investment that we're doing can be easily realizable. They can be easily turned into liquidity, so that when there is,
that would
urgent pressure for us to meet realize this. And I think that, hello, please, can you get me? Hello?
Yes, sir, we can hear you.
Yeah, we can quickly realize those assets. And that is where we thank government and also the for introducing the Ghana fixed income market, where these assets, the government bonds and some corporate bonds are being traded, so that you can easily liquidate these assets and you can meet your liquidity pressure, the needs of your liquidity pressure. Now, in conclusion, we can say that SDIs, certainly we should invest to earn returns. That is important because that is the exact things that we can do to ensure that our banks grow. But then when we're investing, we should also get it at the back of our minds that what kind of assets do we put our monies in, because our depositors will always be coming for their monies. And if we don't invest properly, sometime in the future, some of these assets can go bad and we may be in difficulties. And also, if the assets are so much impaired that it affects our capital and we cannot comply with the regulatory requirements relating to solvency, definitely Bank of Ghana is there to also enforce the law, and we can, through that, even lose our licenses. So as we go forward, we should use the effects of the pandemic that led to assets being downgraded because some investments or some loans that have been given, they couldn't pay back in time, and also the effects of the financial sector reforms, which led to some investment that, even as we speak today, are locked up. They should inform us as to what kind of investments, assets that we should put our monies in. And we thank you all that you are playing a major role on the Ghana fixed incomes, markets, the bonds that are available, the commodity bills that are available, Ghana Cocoa Board bills. I think that if you invest in these assets, you can easily liquidate them, and you can also equally get some returns in terms of the coupon payments, capital appreciation, and all that. So we thank you very much for organizing this, and thanks for your audience.
Thank you very much, Mr. Awuah. And I must say, I'm so delighted that we as Black Star Brokerage, over some time, I think over about 2 years now, we have worked closely with a number of rural banks and SDIs, and closely again with Apex Bank, help them buy fixed income securities, because at this point, right after financial sector cleanup, what is important, and from what Mr. Awuah has said in the presentation, is the quality of the assets you put the deposit into. And we have spoken to a lot of the rural banks across the country, and a lot of them have come on board buying bonds and work closely with Apex Bank to settle that. So I'm so excited that we have stressed the point, the need for us to look at asset quality. Before we move on to the next speaker, I have a quick question for you, Mr. Awuah. And the question is, you made a point about SDIs focusing more on the return and taking the promises from institutions on them giving them higher return on the various investment they propose to them, without them looking at the risk components or attached to the return. Of course, every return comes with some level of risk, and a very basic principle in finance is the higher the return, the higher the risk. So what I want to ask is Apex Bank taking steps to build the capacity of SDIs, especially the rural banks that works with Apex Bank, to make sure they can independently assess the risk component of various investment that comes to them? Because whether we like it or not, they still have to invest, as you said. So are we helping them build the capacity for them to independently assess the risk of these investment that comes to them?
Yes, well, we meet the rural banks, and we also share a lot of information with them. And even as I speak, we have issued investment guidelines to the rural banks, and we believe that our banks will study carefully these guidelines and use it when they want to do investment. And this is also an area that we're going to highlight in our regular meetings that we have with the managers of our institutions. We shouldn't get it wrong again. Going forward, we should ensure that we sanitize the kind of investment that we do. Thanks be to God, we have seen that over time, as Mr. Opata said, the deposits of our industry has been growing, and we need to deploy these funds efficiently. And this is an area that Apex Bank will continue to engage with the rural banks, rural and community banks, so that we refine the investments that we do, and we ensure that these issues are not repeated.
Thank you very much, Mr. Awuah, once more.
Thanks.
Hello? Yeah, I can hear you, Mr. Awuah. Thank you very much. Okay. And I would also add that if any of the rural bank institutions or SDI wants an institution to help them assess any investment that comes their way, at Blackstar, our doors are open for that. You have the capacity to help you assess any risk, do any risk assessment on any investment if you so wish to do so. I have a quick question for Mr. Opata.
But let me make a point. In fact, as I speak, I've seen that some of our banks have shown interest in investing in the fixed income securities. And in fact, as I speak, I think we have a portfolio of about 300 million Ghana cedis, and that is good. And I wish that going forward, that should be the area that they should be thinking, because it is better. Liquidity is assured. You can't experience issues of default, and we have to take note of that.
Thank you very much. And again, we are at Blackstar, as we do all the time. We are very happy to partner any SDI to purchase any fixed income securities, and our footprint on the market is widely known, having been the highest trader of fixed income securities, the highest broker of fixed income securities on the market last year. We are happy to partner with anyone to ensure you get the best return from the market, the best price from the market. So thank you very much, Mr. Awuah, once more. Mr. Opata, there's a quick question here for you. So we just had this question on, periodically when you receive and when you release your report on the NPLs, we see a lot more information on the macro fundamental indicators where we are. Then we see reports on the universal banks where their books are currently, which is very informative, I should say. But I have a question here from an SDI who is saying, why are we not seeing any reports on SDIs like we see for the universal banks?
Okay, so thank you very much. I think I've tried to answer it on the Q&A chat, but I can rehash it. So at the MPC meetings, which is usually 2 to 3 day meetings, we spend a lot of time on all sectors of the economy. And as a matter of fact, the number of presentations on financial developments of the economy, in which there's a lot of discussion on SDIs. But what happens is that after the assessment of this report, then the MPC in the deliberations and coming up with its press briefings, which will have the decision, decides which areas that we want to stakeholders. So depending on the issues that are at hand, if it's deemed at that time that maybe we should focus the communication on certain areas, then that's what happens. So in the last MPC, for example, we gave an assessment and we recognized that the sector has grown compared to the same period last year, which I mentioned some numbers, but we didn't see other risks. So don't see that much comment on. I think I made a general comment that we want to see more credit creation to the private sector. And those were some of the issues that were identified there, but there were no specific issues regarding to the sector that we wanted to stress in the press briefing. If you recognize, there has been other press briefings where maybe the SDI sector may have even 4 paragraphs and so forth. So I think what the committee tries to do is to communicate depending on the issues where we want to focus the discussion on. But I will take that feedback and I will communicate it to the MPC in terms of our discussions. Thank you very much.
Great.
But whilst I have the floor, if I may make one comment.
Right.
On investable products. I think Mr. Awuah has highlighted quite a number of them, but I think one reform measure that we did in 2019 was the introduction of the Global Master Repurchase Agreements to kickstart the repo market to ensure proper credit risk management-based repo market. And in that delivery, we allowed SDIs to also take part in the repo market. We haven't seen much traction there, but I just wanted to use this forum to remind the players in the sector that they can invest in repo. So if you have some liquidity that you don't want to commit for a long time, a good place to invest will be in repo, where you will transfer, you give cash in exchange for full title transfer of eligible securities. And I will want to use this platform to encourage stakeholders here to really embrace that. It's a quick way of making some money, but on a well-sounded credit risk basis. Thank you.
Yeah.
So, I think I'm done. Thank you very much.
Yeah, thank you very much for this information. And also, just on the report bits, if it doesn't come up in the MPR report, if there's a way of them assessing it, maybe some on the website, or if anyone wants to look at, because I believe it's important, and it's a way for investors as well to also assess SDIs and know their fundamentals, and also decide whether to invest in or not. So it would be great if there's a way of assessing them, whether on your website or there's a place that you can go to assess them. Okay,
so that's very good feedback.
Sorry, we can't hear you. I'm not sure if you're on mute.
I'm not on mute. Can you hear me now? Can you hear me?
We still can't hear you.
Oh.
But I can hear you.
Right.
Okay. Right. All right. So after the MPC meetings, there's a monetary policy report that is delivered. I think
those who raise their
some weeks after that. Claudia may want to comment on this, but I think some weeks after the meetings, there's a full MPC report, and I believe a number of documents are released on it's on our internet and our website, and I think it covers financial sector developments, including the sector. But I take your feedback and we'll let the MPC know.
I see a number of hands up. We've noted all of them, and we would allow you to ask your questions. I believe you want to ask them yourself. So before we get to that, we'll have a final presentation from. Okay, so let's get to those ones. I think we have about 4 of them. Then after we will have a presentation with from Mr. Appiah. So the first name we see on there is William. William, you can go first, please. William, if you can hear me, we are going to unmute you so that you go first. William, can you hear me? Yeah, so we'll move on to Anastasia then. Anastasia, if you can hear me, you are on mute, so you can speak, ask your question. Anastasia, can you hear me?
Yes, I can hear you very well.
Sure, I can also hear you. So can you ask your question?
I don't have any question to ask at this moment.
Right, okay, so we saw a hand up from you. Okay, all right then. So we'll move on to the next person. Augustine. So Augustine, you can ask your question if you have any. We also see your hand up. Okay, so we'll move on to Evans as well. Evans, do you have a question? We see your hand up.
Yeah, I have a question for Mr. Opata.
Sure, go on.
Yeah, I wanted him to clarify the comment he made with respect to the investments in the banks or so. He was talking about the limitations or limits on the number of investments one can make in the banks or the SDIs. I don't know whether it's respect to the banks making the investment or an investor making an investment into the banks, if you can clarify that.
I'm not sure whether I made a comment on limits. I don't know whether it's my colleague from the supervision department who may have made. I'm not sure.
It was Mr.
Sabe.
Okay, I think, yes, what I said was that if you look at the Act 930, and what I actually was alluding to was that if you wanted to, if an investor and you are coming in as somebody who wants to partner an existing institution, you want to buy into the equity of an existing institution, we have what we call supervisory structures. And the supervisory structures are 5%, 10%, 20%, up to 75%. So if you want to acquire some of the shares of an existing SDI, then once it constitutes supervisory structures, then the SDI has to seek, before you even commence into any negotiation, the SDI has to seek the prior written approval of the Bank of Ghana. This is what the law says. There, even in the same act, the Bank of Ghana has been given the power to limit some individuals who can even invest in a particular SDI if the Bank of Ghana, in its opinion, deems it fit to do that. So these are some of the issues that I discussed. Hello.
Yeah. So does it answer your question?
Yeah, that's okay. Thank you.
You're welcome. So I think we will keep a couple of questions going.
You can refer to section 49 of Act 930 thereabout. All these are
right. So I have another question for Mr. Opata, which would border on SDI's ability to also access, I should say, funds from the capital market, and we lend it to the private sector as a way of encouraging them. Because when we engage the SDIs, and especially when they are buying bonds, and when you show them the rates, some of the questions they add, some of the concerns, I should say, they raise is the cost of their deposits is a bit high, so it makes it a bit difficult for them to buy these bonds. Is there a way that the BOG is looking to encourage the SDIs to come on the bond market to access funds from the bond market as a way of raising money to lend to the private sector? Because what we see, and one of the functions of the bond market, especially when you are trading the government of Ghana securities, which are supposed to be the benchmark, and when rates are going down on the secondary market, it sort of sets a tone, the benchmark at which a lot of papers can be issued, or on the back of which corporate issuances, which can come from SDIs, can be issued. So we see opportunity on the bond market where in a lower rate regime, they can issue a bit lower to lend to the private sector, which all of us, and even when I look at the speakers from yesterday, everyone was encouraging that we lend to the private sector. So Mr. Opata, are we looking to encourage SDIs to raise funds from the capital markets through bond issuances?
So thank you very much for the questions and comments. Now, I'll take this from two points of view. For the central bank, currently, our focus, really, we've been working very hard at bringing inflation down, because really that's what sets the tone for the interest rate environment. So if you notice, over the past, getting to 2 years, inflation has been trending down. Of course, we had some spikes during the COVID era, and now momentum is towards we are in the corridor, and the outlook is that we will stay within the policy corridor. But what we should be working on is actually bringing inflation down further. At a point, we're looking at maybe inflation getting to the mid-single digit. When that happens, we see that the policy rate can be dropped further. I mean, policy rate is right now 13.5. If the momentum was there to get policy rate around single digit, then you can see that after that sets the tone for the benchmark bonds. That's the benchmark curve, that's the yield curve for the government and other corporate bonds that can be issued in the market. So really everything has to start from there. If the policy rate is at 30.5%, then it's difficult to get other rates lower. And I hear you talking about deposits. Your cost of funds are also high because of the profile of where you are getting your funds from. So this is something that we are working on, and I think the results are coming, but in a very slow manner. One will want to expect that we'll be able to get inflation reined at maybe some middle level. If we're able to do that, then you see interest rate regime come a little bit lower. At the moment, issuing corporate bonds can be done in the given market. But because of the interest rate regime we have, I mean, corporate bonds have to be at a spread of the government of Ghana paper, and therefore sometimes they're higher. So if an SDI is raising corporate bonds to use for on-lending, let's say it's able to do that at, say, 20%. It means that you cannot lend those funds less than 20%. You have to add some premium. So it's a cycle that has to be addressed, and I think that we are working towards that. But a lot of things have to come together well. Of course, fiscal policy must also respond. And that's why we are happy that at least this year, we're going to see some consolidation gaining track again. We're on track, and COVID and some other issues led to an increase in the fiscal deficit. What we are seeing now indicates that probably this year we will be on target, and then hopefully we can bring fiscal policy somehow under control. If that happens, then you can see the corporate bond market maybe thriving a little bit better. So I think I've spoken a lot about this, but I'm trying to answer the question in a quite a holistic manner. Thank you.
Yeah, I think I may want to add something small to what Mr. Opata said. You know, some of the SDIs, who are in good standing, are very solvent, are able to issue what we call medium-term notes, which are traded on the fixed income market. So it depends on the solvency level of the institution. If you are solvent and you meet all the regulatory requirements, capital adequacy, you meet primary reserves, and you want to issue a medium-term note, you write to the Bank of Ghana upon consideration of all the information totality. The Bank of Ghana may grant you the permit to issue a medium-term note, which will become funds that you can on-lend to the market to use as an operational funds in deploying loans to your customers and making income, so that at the end of the day, you can pay all those people who pick up the medium-term note. So it depends on the balance sheet of the SDI itself. Thank you.
Yeah, thank you very much. And I like your answer as well as Mr. Opata's one. So the balance sheets of SDIs are very important. The market players and the interest rate regime needs to go down for raising funds on the capital markets, to become attractive and get it a little bit cheaper than you will get from deposit in terms of what their cost is. So I will just clear this concern someone raised. I wouldn't say it's a question, but it's a concern. Then I'll have the next speaker come in. I think the person's concern was he bought a Government of Ghana bond and later on realized the bond is coming from Blackstar brokerage and he wants to know what it means. So basically, yes, indeed, you bought Government of Ghana bond, and what Blackstar did on that is we facilitated the trade for you. So if you are seeing Blackstar on it, perhaps we are what we call the counterpart. So we are the one maybe selling to you from our clients, mostly pension funds and offshore pension funds as well. So the underlying asset remains Government of Ghana security. Blackstar brokerage facilitated the transaction for you, and I'm sure if you ask the question, we'll have a lot of SDIs attesting to the fact that we've done similar transactions for them. So yeah, that's all about that concern you raised. So the next speaker I'm going to bring on board before we bring the rest of the questions, because we have a number of them, and for me, it's good to see how the audience are engaging with the speakers and raising various concerns that at the end of today, we'll have a lot of issues cleared up. The next speaker, which is Mr. Appiah, who's the managing partner of Blackstar Group, and he's someone who is well known on the fixed income space and the capital market as well. He will speak more on leverage on the Ghana fixed income market to enhance liquidity in a period of transition as we are in now from the pandemic and financial sector cleanup. And as Mr. Awuah said, we have to look at the quality of the assets we are putting deposit into. And fixed income being predominantly now Government of Ghana security has come out to be one of the quality assets on our market. So, Mr. Appiah, if you can hear me, can you take over, please?
Oh, Emmanuel, can you hear me?
Yeah, I can hear you, sir.
Okay, can you see me? Or can you see my screen? I'm about to share.
Okay, so I can see your screen now.
Okay, thank you.
If you can put it in slightly, yeah, that's perfect.
So, thank you very much, Mr. Opata, Mr. Sabin, and Mr. Awuah. I think the discussions we've had here have been more than fruitful for us. And as a company, we really appreciate your time out of your very busy schedules to be with us. It's really interesting because the slides I'm going to go through is basically what I call an economic, which is an economic picture of everything that we've said here, essentially. So when we talk about the banks and their balance sheets, and as you rightly said, coming out of the financial cleanup that we had, banks' balance sheets have changed dramatically. And we can see for the rural banks, for example, that the growth in the bills and bonds that they have has grown significantly over the period, and fueled by healthy deposit growth, which is good overall for a banking industry that we've seen. For the deposit money banks, the picture is the same. We see a strong growth in government securities right across the board. And I'll come to the explanation of that in a second. And I think, when we look at the financial institutions across Ghana, I don't think that we should think that it's a strange phenomena, because as part of the research that we do, we spent some time reading papers from central banks, and we found one that was really interesting from the Bank of England that had done some work on sort of quantitative easing, for want of a better word, in times of crises. And it seems like what happens essentially is people get concerned about, obviously, the economy as it is, central banks ease, and which effectively means that more money comes into the system. And the idea is that money goes into the private sector or into the economy overall. But what happens is that both the economy, or let's say the private sector, is also concerned about the industry. So they pull back. So everybody pulls back. Banks become more risk averse. Clients become more risk averse. And what you see is an increase in cash in the banking system, which then finds its way into no other security that's available apart from government securities. So it's not strange to see that for most of our banks, they have a high amount of investments in government securities. But I think that there are some peculiarities, and I think I share the same concerns that Mr. Opata has, that the private sector has to have, there has to be a way to mobilize credit to the private sector, because it has its own unintended consequence of not being able to get adequate credit to essentially grow revenues on their side, which inherently also grows tax revenue. So you have this almost self-fulfilling prophecy where, the more people are scared to put money in the private sector shrinks, revenue shrinks, and it means government has to borrow more. So I think we do share his concerns around that, and it will be really interesting to see how the central bank tackles that. Some of the things that we've heard from various parties include much stronger databases around credit, like the likes of Experian and FICO scores, and all of those things have to probably play a very important role. And we know some of our clients in the savings and loans and banking sector do a good job of posting the credit histories of people to the credit bureaus, but we as a market overall haven't seen it and been able to access it, because I think once we have some things like that in place, it would really help overall in terms of credit quality, and people will begin to understand how to use credit to their advantage, as opposed to a complete risk-off approach. So the only people within the financial sector who buck this trend is the savings and loans. And I think this is a very a sector that really requires a lot of help from the central bank, because we don't have this as the overall industry. And essentially what we find is that for the savings and loans, they are probably, some of them have, in terms of loan to value, have larger loan to value ratios than some of the larger universal banks, which is a bit strange. Some of them even have larger balance sheets in terms of loans to customers than some of the universal banks have, which is quite interesting from sort of the perspective of, you would have expected, universal banks to have probably bigger balance sheets. So a lot of the burden of real sector lending, in our view, is carried by savings and loans. And I think that sector should be given quite a bit of help in the current times that we're in. So if you look at their balance sheets, you can almost see probably about 75% loan to value for them. And what is interesting is that they don't get the same access to cheaper money that perhaps universal banks get, and so have to fund themselves through bond programs. And they have been very good at managing those bond programs overall. They have been part of the development we've seen within the industry, and we certainly think those institutions should be supported further as they seem to be the real key, real lenders. You know, there's some banks' balance sheets that far exceed their loans. And you know, you wonder what happens, you know, if this continues to perpetuate. But you know, given some of the information that we got from Mr. Opata about the easing in the economy, the improving business confidence, we think that some of that should reverse, and we should see sort of loans and loans to the private sector increase over time. So what has all of this sort of movement into government securities meant over time? So as you can see, you know, the bond market really kicked off in, let's say, 2016. And we started off with 16 billion in trading. And ever since then, it's almost doubled every year. So if you look at the top right corner, what we traded about 108 billion Ghana cedis of bonds. And this is not we as a company, but as a market as a whole. And we'll come to who the participants are. We traded 108 billion in 2020. Just after the half year this year, we have traded 107. So at the half year this year, we've traded the same number of bonds we've traded last year. And what is the net impact of this been? So people would probably think that trading of bonds is a bad thing. But what we've seen is that the blue line that you see just below is the interest rates environment we were in some years back. And even though the debt overall outstanding has grown, the fact that investors can enter and exit positions has meant that the premiums that they would normally require for government securities has declined over time. So the three bars you see there are the rates that we've witnessed over the last 2020, 2019, 2019, 2020, and 2021. And you can see that that's probably some of the lowest rates we've seen in a while. And it's not only due to trading, it's some of the policies that have been put in place. As Mr. Opata said, they are really fighting inflation, and some of that benefit is being seen in a lower curve overall, which is counterintuitive for a debt profile that for a country that has increased overall. So the debt trading that we see has helped in some of that. So who are really the people who are trading in the markets? And this is for the benefit of those who have bond securities and want to understand who the players are. And I think that the usual misconception is that our bond markets are essentially controlled by foreign entities. So if you look at the top side, these are the securities that were essentially bought, and on the right side, those that are essentially sold. And the pinks are the foreign investors, and the blues are the domestic investors. And as you can see from the beginning of the year, and this dates backwards, you would see that domestic institutions are the largest traders of bonds. So that includes companies like ourselves, pension funds, SNIT, and banks overall, which tend to be the largest. So when you look further down and you would notice that domestic players have been quite dominant in the industry over the last few years, 2019, 2020. And in fact, when you look at it, foreigners are becoming less smaller. They're still significant, but smaller than they were several years ago. And that is because as time has gone on and as people have understood the market, there have been more domestic people who have entered the market, which overall is good for our markets, because the more domestic players we have, the less concern we have around currency fluctuations, as our market is essentially controlled by ourselves. So a lot of the work that Mr. Opata and the BOG have done have helped in that, and we hope that that continues over time. So who holds what and where? And if you look at the charts, you would notice that the commercial banks are the orange, and you would see that right across the curve, and when we say curve, we essentially mean right across the maturity schedules that government has. On the 2 years, we see commercial banks pretty much sort of on the shorter dated securities, that's where they dominate. And that was mostly could be said for the past. But I think as investors and banks have got to understand the credit markets, you can see that they have extended their reach right across all the maturities that currently exist, although they are more heavily focused on the front end, which is the 2 years and the 3 years that you see. And then we probably have, in terms of the foreigners, probably dominating some of the back end of the curve, because some of them are portfolio investors who have a much longer term outlook. And it's good to see that your banks are more focused on the front end, because you have you want to avoid some asset liability mismatches, etc. So essentially, what we've seen over time is the growth in the corporate bond market, which we've been very active in. We work for some of the savings, the larger savings and loans, and we've been very good at helping them raise capital. We think that, as the economy grows and as there's a bit of an unwinding from the investment books, i.e. government securities, as the private sector begins and the economy overall begins to pick up. We will see that banks will require a better asset liability matching, and therefore corporate bond programs, in our view, helps them do that. And again, the BOG has been very supportive in that vein. We have several bond programs out there which are currently being renewed by the savings and loans, and we're getting good feedback. Most people are increasing the sizes of their programs. So whilst most people may think that, oh, savings and loans are mainly funded by bond programs, I think that there is a synergy there in that typically the types of investors who do that are pension fund investors, and they have a longer term outlook. That allows savings and loans to also give loans that are effectively lower rates for their clients and have a better asset liability match. So they're able to give out 5-year, 6-year loans to predominantly government workers and also finance that with 5-6-year debt. So that alignment is very crucial for the further strengthening of the financial system. And we encourage those who would look to do bond programs to speak to us, as again, we've done this quite a few times. And we're quite adept at it. Just as a firm, and I don't think we've done this as yet, just to give you a sense of who we are, the firm has been around since 2007, initially focused on private equity and sort of management consultancy. But we pivoted into, when I joined the company, we pivoted into more of the fixed income securities, which has been my background, and asset management. So currently we have several mutual funds, which are some of the top performing funds in the market. And then we have our trading business, which is one of the good performing ones in terms of execution. In terms of our trading volumes, look, we speak to every and anybody. We'll buy a bond at 1 CD, 2 CDs. We are really agnostic. So we serve clients from retail all the way to institutional. So from to date, over the last few years, we've traded about 11 billion Ghana cedis of bonds, which may sound like a large number, but if you compare it to what I showed you before in the years that we've been around, as you can see, just this year alone, there's 108 billion. So if since existence, we've done 11 billion, it's a relatively small number in the context of it, but nonetheless quite significant. And we do have quite an active trading desk. So we would encourage you when you're looking and seeking to buy securities to speak to us. In terms of repo transactions, as Mr. Sabin mentioned, it's something that we can help people structure. We don't take on the risk ourselves, but we speak to some of our counterparties in the market who have gimmerers in place who can execute these things, and essentially over 100 brokerage accounts. So that's really where our trading volumes come from. We always try and execute at the best price in the market for our clients at the lowest cost. And so that's why you see our volumes relatively high compared to some of our peers, because we do this for sometimes zero, just to make sure that we're serving our clients in the right way. In terms of the transactions that we've done right across the market, as I said, some of your peers are our clients. We've done work right across the spectrum on both debt and equity. So we're quite adept at that. Some of our trading partners include the major banks, etc., that we've spoken about and that some of you are familiar with, right across the spectrum. We speak quite a bit to the fund managers within the industry. And that's one thing I also wanted to say. So, you know, there was a conversation around scenario analysis, and as portfolio managers ourselves within the space, what we've done is develop some very good tools around management of bond portfolios. So if you currently have a bond portfolio and want to understand what the risks are within that portfolio, we can help you look at yield curve changes. So if the front end moves one way, if the back end moves, if, you know, Mr. Opata does a great job and lowers interest rates to single digits, which is what we hope can happen, because that's really good for everybody. You know, we don't want to be having mortgages in the teens because that becomes very expensive. What that impact has on your portfolio is very important. And these are things that we can essentially help you with. So thank you very much for your time. And that's the end of my presentation. And I look forward to having any more questions from you. Thank you.
Right. So the first question I have for you is, So just before that, okay, so there's a question on other commissions on purchase and sale of bonds. I think I'll take that question since I'm the boot on the ground when it comes to the trading and of bond securities. So in a lot of the engagements we've had with the rural banks, what we always tell them is the transactions we do for them, whether buy or sell, for any savings and loan or a rural bank, we don't charge any commissions on them. And basically, we try to get a commission from our other partners who mostly will definitely be on the other side of the trade of the transaction. So we as brokers, we mostly will be in the middle between a buyer and a seller. And what we, as a strategic decision, and Agyei is here, you can also add his voice to it, as a strategic decision of the company, in a way to encourage savings and loans and rural banks to participate on the bond market, especially coming back from the financial sector cleanup, where we had a lot of investment in being put up at wrong assets. We want to encourage the participation on the bond market as a quality asset where they can put deposits at. So we don't charge them any commission on that. We do the transactions for free. And we have a number of savings and loans and rural banks who can attest to that, as we did transactions for them, we didn't charge any commission. So the very simple answer to that is we don't charge commission on those transactions. And Agyei is here, he can add his voice to it as he communicated that decision to us as a strategic decision of the company. So Agyei, if you want to add your voice to it.
Thanks, Emmanuel. And yes, I would like to reiterate what Emmanuel said. And we are doing that. We are not charging commissions or fees for our services when it comes to SDIs dealing on the GFIM market, not because probably we don't want to make money, but we see it that we have a responsibility to also help deepen the capital market. So as one of the ways to contribute towards deepening of the capital market, we feel like we should encourage SDIs have reduced cost of transaction. And reduced cost of transaction, I mean, they should be able to come and buy and sell bonds without being charged commissions and fees. So that's why we are doing that. And this is a strategic decision peculiar to us. And it's something we are happy to do for as long as the market remains. So for all the members out there, for all the SDIs out there, when you are considering participating on trading in the secondary market, please add it to your scenarios that we are offering these services to you for free, such that you reduce your cost of funding. So I will go back to Emmanuel for him to continue with the moderation. Then we take it from there.
Right. So I see a couple of concerns on I think how to do bond transactions. So I would suggest my colleague will pick those who are sending those concerns so that we engage them after the program, so that we don't limit the discussion to only buying and selling of bonds. So my colleague will pick the names and follow up with you, and we can have those discussions on how we want to buy or sell a bond. And it doesn't go through a difficult process. So I think we will engage you after. I have a question here for Mr. Opata, and the audience wants to know whether past as a guide in terms of the activities that happened before the cleanup, what key steps must players within the industry put in place to prevent such happening? I know a lot of presentations have been done on that to give comfort on what we need to do to avoid that. I don't know if Mr. Opata, there's anything you want to stress in relation to this question.
Thank you. Well, I think my colleague from
Do we have more of that? Do we have more questions?
Yeah, I'll take it up.
And if anybody else raised their hand.
I'll take it up, Mr. Opata.
Thank you.
Yeah, I think from the cleanup exercise, what came to the fore was that most of the issues bordered on corporate governance.
Has anybody raised their hand? Has anybody raised?
Hello?
Yeah, we can hear you.
Hello? Yes, most of the breaches bordered on corporate governance. So if an investor into the SDI sector or NMF sector is to make gains, they have to ensure sound corporate governance principles. Because if you enforce sound corporate governance principles right from the stage of incorporation of your SDI to profitability and solvency, your institution will do very well. You must get the right people who are to partner with you as your investors. They must be people of integrity. You must employ people who have the expertise and requisite qualification to serve as your key management personnel. You must have people on the board, the directors who are competent, directors who can speak their mind, who understand the issues, not directors who act to the beck and the call and beck of the shareholders. No, that's why the Corporate Governance Directive, per Section 21 of the Corporate Governance Directives, every SDI or bank must have an independent director on its board. An independent director must be somebody who can speak his mind. He is not affiliated to anybody with respect to relationship or employee on the SDI. So if you have all these things in issues and then you comply with the prudential requirements by the central bank, certainly your institution will be a very good institution. And if you look at the Bank of Ghana press release over the period of the cleanup exercise, you may agree with me that about 3/4 of the SDIs whose licenses were revoked breach corporate governance directives, which are fundamental. This is my answer to the question.
Right, so there's another question for you, and the person wants to know if an MFI has invested funds by way of fixed deposits in an existing savings and loans company, and the MFI is unable to access the fund now, how and what steps can the MFI take to retrieve the fund?
Yeah, that one is a matter of that MFI having a dialogue with the SDI in the first place, because these are contractual relationship between the person and the institution. You can also write to the central bank to intervene, which we have received a lot of applications from people to that extent, and we'll call a meeting amongst those parties to see as to how best they can pay the funds. At worst, it's a contractual relationship. You can go to court for breach of your contractual rights.
Okay.
But that is the extreme advice.
Right. Okay. And there's a question here for, I believe, Mr. Opata. If a microfinance company wishes to invest in BOJ bill with Apex, or I should say, with Apex, what are the approach or the equipment, and especially the weekly bill? I want to believe they are not able to purchase some of the weekly bills. So if they want to buy, what are the process they need to go through together?
Thank you very much. So for the rural banks and that go through the Apex Bank, they just, the BOE bills are issued every week, right? They just have to the inquiries or requests with the Apex Bank, and then the auctions they'll place on the auction. Apex Bank will place for them on the weekly auctions that happens on Mondays and Wednesdays. As far as systems are concerned, I cannot speak to how their orders will get to Apex Bank. I think that's something they may have to engage Apex Bank on it. Apex Bank knows how to come on the weekly BOE auctions. So all those requests will then come to the auctions, and then we will facilitate the transactions. So essentially, they go through Apex Bank. The technology they use to get to Apex Bank, I think they have to engage Apex on that. And then once we receive the bids from Apex, they should be eligible to participate in the auction that are held on Mondays and Wednesdays.
Right. Mr. Awuah, since Apex has been mentioned, do you want to add anything to this question?
Oh, yeah. Yes. Now, per the existing arrangement, you see, the only customers of the ARB Apex Bank are the rural and community banks. And for that matter, all the investments that we do it on behalf of the rural and community banks. It is an area of discussion that we need to introduce so that if possibly going forward, we can expand the services to microfinance institution, MFIs, that could be of great assistance.
Thank you very much. So I'll move back to Eric. And in your presentation, you mentioned and showed the footprint of the company in the corporate bond issuance space. And yeah, when we look at the numbers as well compared to the GOG, we still don't see a lot more from the corporate issuances. And I just want to know from you, and I'm sure some of the SDIs want to know, what are the main challenges in relation to really participating on the corporate bond? I know a lot has been said about the rates being high, and as a result, it makes it difficult for you to add some basis points on the benchmark for you to really raise funds. Also, the books of the SDIs, a key factor. What other things have been a challenge in raising capital from the corporate bond market?
Sure. Thanks for that, Emmanuel. And then apologies to all. Mike, for some reason, my camera has decided not to work, so I haven't been able to switch it on. But I think key in the sort of the risks or the challenges that we've seen for some of our clients are
If not, then
so most people come into bond programs because they want to have better asset liability matching. Typically, what you see is that the investor community is a bit shy of some of the smaller financial institutions, because I guess in the past, balance sheets were highly skewed towards, let's say, unsecured lending. So even when you look at our sort of corporate bond market, the majority of those who have issued are involved in payroll lending. And because most of that is to government workers, there is more security around the loan book. But we've also seen, and for example, we worked on the Ghana Home Loans Bond Program, which was quite an innovative one in that it was a mortgage-backed security that was issued into the market, which did essentially well. But in terms of the main challenges, I think it's more to do with investor perception than, let's say, the ability for an SDI not to be able to issue into the market. But I think as, you know, in pension fund investors, allocations have grown to government, they are now looking for other ways in which to grow their balance sheets. And so some of the things that we've thought about, and maybe not necessarily for this forum, is, you know, other forms of capital. Because I think currently what we do have is straight equity or debt. But there are some also mezzanine structures people can look at. And those are some of the things that, you know, for example, we think may make sense in the insurance industry, because it's loss absorbing capital. But what it also does is it reduces the potential for dilution from shareholders. Because one of the things that we also see, or concerns that, you know, SDI have, is because their balance sheets, and this is in relation to equity, not necessarily debt, is they would love to raise more equity, but the prices that sometimes, or the valuations at which sometimes they raise this money, means that they are essentially, their equity holdings come down. Now, if there was more room to issue, let's say, quasi-equity securities, which there is currently, and people looked at that option, that would pretty much help them solve a couple of problems. One, you get your capital, and two, you reduce the likelihood that you get diluted as a shareholder, so that as your business grows, you're able to get the benefit of that overall. But on the bond side, I have to say in the past, we didn't get much response from the Bank of Ghana because they don't really interface us. And so sometimes when we saw, when we went with our clients, we wouldn't be sure what the issues were. But I have to say more recently, or over the last few years, that communication has really improved. Whenever there are issues, we hear them from the Bank of Ghana. A lot of the issues are things that actually don't even involve us, but necessarily BOG is expecting some governance issues to be resolved, some capital issues to be resolved before they go ahead and approve some of these things. But as I said, it's really important that, you know, for the large part of the sector, which is the savings and loans, which depend on these corporate bond programs, that the approval process is a bit quick, because again, that's the lifeblood of these entities, because they do not have the luxury, as I mentioned, of the sort of lower cost loans, deposits that some of the rural banks and potentially universal banks get. So they're in a bit of a unique space. But I have to say overall, from where we sit now, the level of communication with the BOG and the regulators, that's both SEC and the BOG, has improved markedly. And so it's really up to now the SDIs to be able to test the market. We have some interesting structures in mind, which involve some sinking funds, protect investors, and things like that. So we'll be more than happy to have that discussion with potential SDIs who are thinking of coming to market.
And just on, you know, thinking about various approaches of raising funds, or, you know, raising capital for SDIs, I want to ask Mr. Opata, just in case an SDI wants to use the preference share approach, what tier of the capital, you know, the tiers, that the capital tiers that we have, which tiers would that fall under if they want to go the preference share approach in raising capital?
Thanks. I think this question too should, my colleague Mustafa, want to have a take at it. It's more in his domain. See, when I can answer questions, then I defer to Mustafa. That's an easier way.
That's right.
I'm sorry, can you repeat the question for me? I got distracted by some.
Yeah, so the question was on, if an SDI wants to raise capital through a preference share, what capital tier will it fall under?
Okay, that should be the tier 2. You know, we have with the issuance of our new guidelines, although the SDIs have not been strictly been enforced as pertains to the banking side or the banks. We have the common equity tier 1, the AT1, and then the capital conservation buffers. So the preference shares will constitute as a secondary source of capital. But before that can be done, you have to inform the Bank of Ghana for us to assess it and see what are the underlying benefits on it before we approve it. So that's the current situation. Well, we need to know what are some of the whether you're issued as a, is it cumulative, is the interest rate cumulative, and for what period? All these issues must come to the fore. So you have to apply to the central bank for us to review that, the nature of the preferences.
Right. Thank you very much for the answer. To the audience, if anyone has any concerns, they want to ask the question directly, they can just raise their hands and we would allow them in. So we'll just leave about 5 minutes for that if anyone has any concerns. If not, Agyei will give the closing remarks and we can bring the program tonight.
What I may want to say is that currently, if any potential investor wants to invest into the SDI sector, you know, the minimum capital requirements for now for the SDI is 50 million. It has not been increased yet by the Bank of Ghana. Then for the microfinance company, the minimum capital requirement is 2 million Ghana cedis. And if Mr. Awuah may affirm this, for rural community banks, I think it's 1 million Ghana cedis. So these are certain things that I should have indicated in my presentation, but for time purposes, I skipped those issues. So that's what I want to add.
Right. I guess we will continue with that by asking for final comments from Mr. Awuah as well.
Right. Thank you. Now, Mr. Mustafa made mention of the capital, the minimum capital requirement for the RCBs. That is 1 million, as you said. But what I'll say is that
How do you get our numbers on this page?
engagement. Hello? Hello?
Hello, sir, we can hear you.
Yeah, okay. Now, the engagement has been very fruitful, and we thank you so much. But I will continue to urge our SDIs to always look at the environment within which we live. Very uncertain. But then at the end of the day, prudence should be the watchword. Yes, Bank of Ghana abolished the secondary reserve requirement some time back. But then if we're doing investment, we just have to be very careful so that we invest properly, so that we are not caught up in the uncertainties of the future. When you are in liquidity crisis, it is very painful and difficult to manage. And we will continue to urge our institutions, if they should always seek advice, if possible. And ARB First Bank will always be there to assist them so that we can do prudent investment, get adequate returns, ensure we have liquidity so that we can serve our customers well. Thank you.
Yes, sure. No, and thank you for that. And really, for me, it's just to really thank our regulators, Mr. Awuah, Mr. Opata, Mr. Sabin, for joining us on this discussion. I think as a firm, we try as much as possible to get to understand our regulators. You know, the comments you often get are the regulators are unresponsive, but I think today is a really good example of the fact that that is not true. As I said, when you engage with the regulators in the format and in the way that they want to, you find them very responsive, and we're very thankful for that. I'm also very thankful for all the institutions that have joined us today. And really and truly what we want to do is seek to build stronger relationships with yourself, essentially help you manage your portfolios and your investment decisions. So we're more than happy to look at any side of your capital structure, be it debt or be it equity, be it mergers or acquisitions. We're more than happy to help you on that. So I'd just like to thank you for spending your time with us today. Yeah.
Thank you too.
Right, Mr. Opata.
So I think I want to thank Blackstar for organizing this. I found the session very useful and actually very informative. I've learned a lot from the stakeholders, and I think it helps in policy making. And takeaway from this is that such engagements are useful and helps in information dissemination and forming expectations. I think that the economy is beginning to regain some momentum in terms of growth. Inflation is stable, at least for the short term. We have aligned some risks that are ahead of us. And the key one is the uncertainties surrounding the COVID dynamics and how it plays in our markets. But you can take the assurance from the Bank of Ghana is that we will take the appropriate policy measures to ensure that inflation is stable and other prices are stable in the economy, and to the extent possible, support the growth momentum and help stakeholders such as yourself and good risk-adjusted returns. That is, returns that are based on proper price discovery and appropriate risk-taking. And I really want to thank you for the engagement.
Thank you very much, Mr. Opata. So we would send email of the presentations, especially the one from Mr. Appiah. And if anyone would want to have the recordings of today's program, we'll also send that to you. Then we'll also put in our contact information. You can as well go to our website if you want to know more about us. But then we'll put our contact information in there if you want to do anything, if you want to purchase bond, especially those who were asking questions on bond purchases and bond sale. You can engage more on that by hitting us up via email or via the phone numbers that we'll put in the emails. So thank you very much. At this point, I'll hand over to Agyei so he gives the closing remark.
Thank you, Emmanuel, and it's been a very good forum. It doesn't come easy to have all players in one forum sharing ideas from the policy side, from the people on the ground. So it's been very effective. My closing comments, I just want to issue this disclaimer, which sometimes used to come up when we engage with people in the SDI sector, that due to some past experience, they felt like our modus operandi was to also go around, take deposit from institutions and individuals and promise them return. We've never operated that way, and that's not how we do. What we do when it comes to securities trading, we do intermediation for your trading, be it government bonds or be it cocoa bills. And also when it comes to capital raising, we get to understand what you need, then we help you out. So I just wanted to clear that once again, so that you know that the Black Star team, the Black Star group, that's not how we go about our things. It's been a very good discussion, and I think all of us are taking a lot away. Like Emmanuel said, we'll be reverting back to you with more details. Feel free to also get back to us if you have any other. One other thing that we'll keep on doing it, and we are happy for the collaboration from the regulators and the Apex umbrella body. We are happy to help build the capacity of the SDI. So if they need any information, we can even organize bond market orientation, just as we've done for some that we deal with. If it is about raising capital and you need some orientation, we're also available to do all this. All I'm saying is see Black Star as a very crucial partner for your growth. And I think by so doing, we'll become resilient such that whatever the challenges that might come, we will be able to withstand it and thrive thereafter. So I thank you all for coming. It's been a successful day too. Tomorrow is the last day and it's a session for the insurance industry. But if you want to join, feel free to join, because the conversation might also be related to you, since we are all in the financial sector. So adios, and we'll meet you on the other side again. Thank you.